Are you tired of the rainbows and butterflies approach in multifamily investing, where everything unfolds seamlessly and everybody wins? You never see behind-the-scenes reality. If you resonate with our perspective, acknowledging that true insights emerge from navigating mistakes and challenges, then you're in the right place. Join Christy Keaton, your host, as she dives into the missteps and lessons learned encountered by active apartment operators. In these episodes, we embark on a journey to dissect and analyze the pitfalls within the multifamily project lifecycle, focusing on the crucial stages of finding, funding, fixing, or flipping a project. Instead of glossing over setbacks, we shine a spotlight on them, providing a valuable learning experience for our audience. Each episode concludes not only by revealing how the issue at hand was rectified, but also by sharing other priceless lessons derived from the experience. It's an unfiltered exploration of the multifamily investment landscape, revealing the intricate tapestry of challenges and solutions that make the journey worthwhile.
Hello, family, and welcome back to another episode of Multifamily Missteps. My name is Christy Keaton, and I am your host. And today we have a very special guest, Mr. Gino Barbaro, and with Jake and Gino. And let me tell you just a little bit about him, and then I'm going to let him take over and start adding some value. Mr. Gino is an entrepreneur. He's grown his real estate portfolio to over 2,000 multifamily units, which is about $250 million in assets under management. He has a partner named Jake, as we all know, and they teach others how to do the same thing through Jake and Gino, a premier multifamily real estate education community. To date, listen, guys, to date, their students have closed over 68,000 units and have done more than $4 billion in deal volume. He's also a best-selling author, a great husband to a wife, and a father to 6 children. He resides in Florida. Welcome to the show, Gino. It is an honor and a pleasure to have you on this show today.
Thanks, Christy. When you announced me and started the introduction, you said host. I thought you were going to say co-host because I've done so many podcasts and you say you listen to my podcast. So
I do.
It's an honor and it's a privilege to be on. Thanks for having me on today.
Yeah, absolutely. First and foremost, when I read 68,000 units from your students, I was blown away. I got to be honest with you. I didn't know that number. So I'm like blown away because I know going through the 2,000 multifamily units that you closed, going through the 68,000 units that these students have closed, I know that there are some add values that you can add to our listeners today. But the first thing I want to do is I want to go over who's Gino, like where did you get started? How did you get started? Have you always been in real estate? And how long ago was that when you started your real estate journey?
I will give you the condensed version because I
Okay.
think it's important for us to just to jump in and really talk not just multifamily, but I want to talk about money and the relationship with money and a little bit of psychology that goes behind it, because that's
Awesome.
probably the biggest mistake that we make. For myself, I started out in the restaurant world. I was the pizza guy until I didn't want to be the pizza guy anymore. That's the
Yeah.
reality. I figured out that it was great early on, making money every week, building a little business, being able to live the middle class dream. And all of a sudden, '08 comes and it rocks and shapes this country, I think, for the next 100, 200 years.
Yeah.
It just changes everything. It changes our
Yeah.
habits.
Yeah.
It changes our psychology. And I didn't want to be at the restaurant anymore. And I met Jake, thankfully. I had invested in a bunch of mentorships before I met him. So when I met him, I had the value of, okay, I know real estate. I know multifamily. Jake, you moved to Knoxville. You have the market. You're the boots on the ground. That's
Yeah.
the first mistake that people make is they partner up, not knowing why or how they create value for the other partner, or even more importantly, their values aren't aligned. Jake's values and my values were both aligned. We both had those ideas of integrity, the ideas of long-termism, the ideas of let's just stick to multifamily. Who cares about crypto? Who cares about self-storage? We need to get good at multifamily. And those
Right.
are some of the things early on that Jake and I figured out because I had made all the mistakes before I met Jake. I always say there's life before Jake and there's life after Jake. And
There you go.
life before Jake for me was not having a plan, a blueprint, a process. We
Yeah.
call it buy right, manage right, and finance right. I figured that out after we bought our first deal. And if you're listening and right now and you're in any real estate niche, you need to know how to buy the asset. You need to know how to finance it. Those are the 2 back legs of what we call our wheelbarrow. And the manage right is in constant motion. And if you're looking to buy a business, looking to buy a single family home, self-storage, mobile home park, whatever the niche is, you need to be able to follow that framework if you want to have a good deal.
Absolutely, absolutely. I want to point out that one of the main things that you really hit on was your partnership. And it's so, so important that you find the right partner to no matter what you decide to do, whether it is the restaurant industry, like you were talking about, or multifamily or anything else, find the right partner. And it seems like you've got the right partner in Jake. And we've watched your journey. So I have for sure watched your journey. And I've just watched how you and Jake have literally blown up the industry in a great way. And so I'm really appreciative for like your webinars that you do and your podcasts that you do, because you do add value on a daily basis to people that are in the industry. So thank you so much for that. So how long ago did you start your real estate or multifamily journey?
Life before Jake started in 2002 at the triplex. And here's maybe
Okay.
the first misnomer: you got to go big or you got to go home. I think that's I think it's pretty much rubbish. I started with the triplex. And if I hadn't started with the triplex, I may never have started. I
Yeah.
think behaviors are belief driven. If you believe you can do something, then you can do it. I could see myself closing a 3 unit. Then I could see myself closing a 6 unit. But if I'm here sitting and saying to myself, I need to close this 50 unit because that's what somebody told me to do, is to go big and
Uh,
economies of scale and blah, blah, blah. I'm not going to convince myself to do it, and I'm not going to take the actions that I need to close the 50 unit. So for me, I started with a humble 3 unit. Then I started making my mistakes. Then I got into a mobile home park. Then I got into a strip center. And after those two, I said, time out. What do I need to focus on? Where do I need to recalibrate myself? And listen, it wasn't the investments themselves that were the mistake. It's I was the mistake. I didn't know what I was doing. I committed so many
mm,
errors early on. And I think we always want to blame the thing that we're in, whether it's I'm at the restaurant, whether it's the real estate vehicle itself. It's not the vehicle. It's the person driving the vehicle that doesn't know what they're doing.
oh, that's good. That's really good. That's really good. So when you bought your triplex and your strip center and the mobile home park, and you say you didn't know what you were doing, had you already gone through the educational programs at that point, or did you choose after that to go through an educational program and really level up at that point?
I'm going to say something that I want you to take note and learn from my mistake. There's two ways that you learn in this world. You either learn on the street or you learn in the classroom.
Oh, that's
I
good.
have documented evidence that everybody who learns on the street, they'll learn eventually, but they're going to make a ton of mistakes. They're going to lose a ton of money and they're going to waste a lot of time. And I did all three of those. On my
Mm,
very first deal, I invested. I had no idea what I was doing. I was taking this massive action. We say education times action equals results. Well, great. I was taking the massive action. I thought I knew what I was doing. I had money. This guy had a deal. We partnered up. 18 months later, that money disappears. And I
mm,
wish I had said to myself, time out. What did I do wrong there? Instead, I jumped back on the horse, not knowing what I was doing. And I went into a different niche in a different market by myself, knowing that I thought that I knew what real estate was really all about. I invested in that deal. I held that deal for 10 years and I lost a ton of money. But the lessons that I learned on that second deal were invaluable for me to learn and to take along with Jake.
yeah, yeah, that's good. That's good. So on your journey, the triplex, first of all, do you still own it?
We don't. And I sold that deal back in 2022. I had owned it for 12
Wow.
years. And there's another, I bought it, I wouldn't say totally right, but I bought it with the fact that it was down the street from my restaurant. So I used it to store stuff. So I used it as a storage area, right? And I
Okay.
started paying myself rental income. So instead of getting income from the restaurant, I was avoiding some type of social security taxes because I was
Yep.
legitimately using it as a storage area. But the problems with that, I didn't do my due diligence. There's three forms of due diligence that you need to perform when you're buying an asset. The first one is the financial due diligence.
Mm,
Before you sign on the dotted lines, you get your purchase and sale, you're getting all the documentation, you have to make sure that the numbers are fabricated, the numbers are right. And on that deal, they were. There was a triplex. There was nothing shocking. The second part is where I failed, which was the physical due diligence. Although I did get the money back. I found some oil tanks buried. I found some other deferred maintenance. So we actually
uh,
got some of that money back. That wasn't a big deal. The third one was the legal due diligence. I bought a triplex thinking that I bought a fourplex. It was a
oh,
fourplex, but it
oh,
was a legal triplex with an additional garage that they had been renting as a unit. The town knew it was there, but no one said anything until I went to get refinancing on the deal. And I had to go through that whole rigmarole. So as you're listening to this, 3 forms of due diligence: your financial.
Yes.
If everything passes with the numbers, then you go ahead and you do your inspections and you do the physical. And as you're doing that, make sure that you hire somebody to get title insurance, to make sure you have active certificates of occupancy, that there's building permits, that there's fire safety hazards, water systems, whatever that is, it's all transferring over to you. And if it's not done correctly,
Yes.
whatever mistakes there are, you are going to inherit those mistakes.
Yes, and inheriting those mistakes will cost you money and
Oh,
cost your investors money. So you want to make sure your investors are trusting you at that point with their money. No matter if it's $5 or $500,000, they're trusting you with that money. So in order for them to invest, you need to make sure that everything's in line. Especially, a lot of people, and correct me if I'm wrong, a lot of people will buy, out of state properties, whether it be single family, multifamily, it doesn't matter. And they won't have boots on the ground and they'll go ahead and close. Right. So they may do an inspection, but maybe something's missing the inspection that you need to put your eyes on, or at
mhm,
least some boots on the ground that will put their eyes on it. So
mhm.
make sure that you're really doing that physical due diligence as well, because that can cost you a ton of money. Okay. So tell me a misstep or a mistake along your journey. 2,000 units for you and Jake and 68,000 units for your students. Mind blown there. What kind of mistake or what kind of misstep that stands out above and beyond the rest of them that you can talk about, that maybe our listeners can kind of sidestep that misstep and not have to step right into it?
So what I'll do is I'll use the framework and I'll try to pull out a mistake from the buy right, mistake from the managing a property, and mistake from financing a property.
Perfect.
So for buying a property, and this is what most newer investors say to themselves: I need to find a deal. What's a deal? I need a deal. And before they actually sit down and actually think about what a deal is to them, because what a deal to an experienced investor is a lot different than what a deal to a newer investor looks like. So understanding what your goals are, understanding what your buy right criteria is,
Hmm.
understanding where you're buying in the market cycle, and understanding what type of assets you're trying to focus on, what type of returns you're trying to achieve. You want cash flow? Do you want appreciation? Do you want to invest in this certain type of market? All that buy right criteria is important. And when I bought my first deal, all I was looking for was a deal. I was looking at what we call IRR. Great, great. Anyone can make up an IRR number and it looks great, but you got to dive a little bit deeper and you have to understand the underwriting. And for you to be a really good at, I think, at investing in real estate or multifamily specifically, you need to be an expert in that market. That's why when you start, don't start with 3 or 4 markets. Start with one market that has enough deal flow and become an
Yeah.
expert. Learn the brokers, learn the income, learn the expenses, learn the median incomes, learn the little quirks in the market, understand what that is. So from the buy right perspective, not knowing what you're buying and why you're buying it is a huge mistake. And to finish that one off, understanding what your exit strategy is. You're not going to buy a
Oh,
deal, and maybe you do. We've held on to most of our deals, but hey, at one point, you're going to need to exit this deal, whether it's a refinance or whether it's a sale. So understanding what that looks like and how you're going to achieve that is really, really important. Now, on the finance right, listen, we like long-term fixed rate financing. We don't have any bridge debt deals. We could have done them over the last 2 or 3 years. We didn't do them because we saw the risk, because you're coming out of an inflationary market where it's hard to find materials, it's hard to find
on.
supplies. Interest rates are so low, sooner or later they're gonna go up. And
Yeah.
that's what ended up happening. Did anybody know that rates were gonna go up a lot quicker than what they did? No, but they shocked the system, and not having proper financing is going to kill a deal. Now, for
That's
myself, yeah, I didn't have. I'm trying to think of as far as the mistakes that I made on financing. I really didn't have any financing mistakes. We did some really great seller financing deals. So if anybody's out there looking to get into real estate or trying to grow the portfolio, just Google seller financing and creative financing.
yeah.
We have a book that we
Yeah.
wrote, Creative Cash. If you want a copy, just email me, Gino@jakeandgino.com, and I'll send over a PDF. That's such an amazing tool. And master lease options is another one. That's another tool that you're going to see happening in this part of the market cycle. Now, on the manage right, geez, we could spend hours on manage right, but I think ultimately the mistake that I made early on with Jake before we hit 500 units, it was, I'm going to do this, I'm going to do that. And what we say is AMA gets burned out because you have 2 or 3 properties. It's really good. You can handle it. But that's not the idea of real estate. If you're buying 1 or 2 deals a year, by year 4, you've got 7 or 8 deals. It's really
Yeah.
hard to manage them. So you have to start implementing systems. right? You have to start talking about people, systems, and culture is what we talk about. And the reason why I only had one restaurant for 20 something years, and within 5 years with Jake, I had over 1,500 units, it's because we had things like core values, a mission statement,
Good. Yeah.
culture, all of that. Understanding ultimately that real estate is a scalable business. You're becoming an entrepreneur. You're not just buying these homes and becoming a landlord. That was probably the biggest mistake and the biggest aha that I've had in my career is like, wow, you know what? This is a scalable business. If I implement systems in any business into my real estate with KPIs, with things that I can track, with having rhythms in the business, all of a sudden you start treating it like that and it starts paying you really well.
Absolutely. Oh, those are some good bombs that you just dropped there. Let's talk a little bit more. Let's go back and talk about a little bit more about your buy right. So how does somebody come up with the criteria? Like Jake and Gino has their criteria that they look at before they buy a deal. How would you say, like, give me like the first three things that you'll look at, if you will, on buying right? I know what my first three things are. But what are your first three things on what you would do if somebody says, Gino, you got to look at this deal. This is an awesome deal. I've already done this, this, and this. What do you do when you look at that deal? What are the first three things that you look at?
I love that question because I'm going to sound like an attorney right now. It depends. It,
Oh,
it, it depends. It depends on the market cycle because the
okay.
market cycle is so important because when we started buying in 2011, people don't remember. There was a ton of deals out there. There was no money. We were buying old assets because C properties were trading at 10 caps, 11 caps, 12 caps. As the market escalated, and you know why though? They traded at those prices because rents were $300 for one bedrooms. Now
Yeah.
rent $1,100. So people have a short-term memory. There's a lot of risk buying at that part of the market cycle. So risk reward, you're going to pay less. Cap rates are going to go up. So what ended up happening as that cycle started to, lengthen and where we are right now, a deal for us right now in this part of the market cycle, because C assets have not come down in price where we'd like to. We want assets that are newer. Our last three deals, 2008, 2018, and 2019 vintages.
Okay.
We like townhome style apartments. We love them. If they have garages, home run. But it feels more like an apartment complex. That it feels more like a townhome or really a resident, a home than an
Yeah.
apartment. I think the third component, I can give you a couple more. We like median incomes
Sure.
of at least $50,000. Anything lower than 50,000, it gets to be a little bit more challenging with a resident base. Anything above 50,000, they're able to pay their rent. They're able to actually, it's easier to manage that resident base. We love washer dryer hookups, that amenity right now in our market. And I should preface this by saying every market is different. You may be living in San Francisco and saying, bro, 50,000 median income, I can't even afford a studio. Well, understand where your median income should be in your market. But we know in our market, 50,000 can get you a rather good renter. So you got newer vintages, washer dryer hookups, townhome style apartments. We love 2 and 3 bedroom apartments. Listen, we'll get the ones, but ones they generate less income. They tend to be a little bit more transient in our market. Now, if you're in a market that has a lot of university jobs, has a lot of older people, that 1 bedrooms may be well. But for us, 2 and 3 bedrooms work really well in our market as well.
That's awesome. That's awesome. Yeah, the market, that's one of the very first things that I look at is the market, and then I look at the crime rate in the market.
Yes.
And then the age of the property also comes into play because I don't want to deal with aluminum wiring or
Yes.
cast iron plumbing, all that. I don't want to deal with that.
Chris,
So,
you don't mind dealing with that if it's for the right price. If you're going to
well, for
pay,
the right price, right.
yes,
Right.
that's my point. Like these assets that we were buying back 10, 12 years ago, they were 35,000, 40,000 a unit. You're budgeting
Yep.
another 10,000 for all these repairs. You're at 60,000. But when you're buying a four cap that's built in the 60s and you've
True.
got to put additional capex, that four cap becomes a foreclosure. That's what ends up,
Yeah. Oh, that's good. Yeah. That's good. Woo.
right?
It's really good. Yeah. All right. So let's move on just on to your financial. What are the top three things that you look at when somebody says, I've already written this deal and it's a 16 IRR and you're getting your eight cash on cash. You look at that underwriting, you go, hmm, what is the first thing you're going to look at?
It comes back to me for the buy right criteria. Are these actually achievable? So I'm looking at this
Okay.
deal. People always say, look at the underwriting. No, I want to understand where there's value in the underwriting. Can rents
Okay.
go up 10%? That's the first thing. Do I want to hold this asset in that market? If you're looking at my market in Knoxville, I want to know where it is. In the east part of Knoxville, not really interested. I want
Right.
to understand where it is. I want to understand if they're conservative with income and if actually expenses are going up. That's important. Also, in the underwriting, where's their CapEx budget? I want to see where their budget is. And I want to see if they are over raising on their capital and then giving it back
Overweight.
to me and calling it cash flow.
Oh,
Not illegal to do, but a
no.
lot of traders have done that. So you're giving me
Mm,
my money back and you're calling it cash flow. Not really cash flow to me. Not saying that it's right or
mm,
wrong. Just
it's not,
understand.
yeah, it's not wrong. It's just a little sneaky.
Yes, it's not cash flow. You're giving me my money
Yeah.
back. Now, if you're saying to me on our very first syndication, we didn't know how much of a baseline we needed. So we did raise additional funds. They went into the CapEx account, which was separate than the draw account. Every
Yeah.
time we did a capital project, CapEx funds would go into there, but we never drew it back to the investors. That's what I'm talking about,
That's good.
commingling funds like that. So when you're looking at an underwriting and you're looking at this, the viability of the plan, understanding most importantly, who are their team members? Like you're talking to me about underwriting, but I'm not even looking at that. I'm looking more at what we call a 3-step framework for passive investing because you're looking at it through as if you can't control this thing. I need to look at the sponsor and I need to vet everything about the
Yeah.
sponsor. I need to vet their sponsorship team, but I need to take a deeper dive. I need to take a deeper dive into their property management company they have, even if it's themselves, their
Yep.
asset management company, their CPAs, their cost segregation, their syndication attorneys. What does that team look like? More importantly, and I don't care if they've made money in the last 3 years because a lot of people have made money in the last 3 years. Their track record
Yeah.
is difficult unless they've had a 7, 8, 10, 12-year run. But I'm looking at this asset and I'm saying to myself, is this achievable? Can they get the rents? Can they do it in this time frame? And looking at the asset itself, what is the exit strategy on this thing? I want to if I'm looking into a syndication and I'm putting money with somebody, I don't really want my money back in 3 years unless it's a refinance. So understanding that I need to align my goals with the syndicator's goals is really important. Now, if the syndicator's like, you know what, I'm keeping your money for the next 10 years, we're going to keep plowing it in, I may be okay with that. But Christy, you may not be okay with that. So
Right.
understanding that from a personal level, where are you getting your funds from? And are you okay with that company keeping the funds for X amount of years? Or do you want them back? Understanding that is really important.
Yeah. Yeah. That's good. That's good. Okay. Let's turn the tables just a hair and let's talk about your biggest challenge that you had over the last, 20 something years now in the real estate industry. What has been your, like, the legit biggest challenge that Gino has had over those 20 years?
I'm trying to think if anything really stands out. And for me, I think a lot of us go through this when we start out, and I don't want to call it imposter syndrome, but it's almost like the get there-itis, where you want to do a deal and you're so hungry to do a deal that you'll compromise. I don't want to say your principles, but you'll compromise your buy, right? It's a 1962. It's okay. I'm paying 70 a door. It's really worth 62, but I'm paying 70. I can overpay. And those mistakes will ultimately kill you. And that's what I did earlier on in my career. And as
Mm,
I got older, I was able to say to myself, I'm not going to make mistakes. No deal is better than a bad deal. And you
yes.
learn that through
Mm,
experience. And I
yeah.
think if you're getting in this business, it's so hard to project out 10 years. I don't want to say unfathomable, but most of us can't do it.
Yeah.
But if you buy one deal every 2 years for the next 10 years, and they're really great deals, at the end of 10 years, you've got 5 life-changing deals. I'm sure you could do anything you want with the rest of your life. But if you say that to somebody like, I can't wait 10 years, but 10 years, COVID's almost
Those-
5 years. COVID's almost 5 years that we've been that when COVID hit March of 2020. If you think about it, that's insane. So just take your time, understand the market cycle, and understand what strategies work in what parts of the market cycle and what assets to buy in certain parts of the market cycle. And if you can do that, I'm not telling you to time the market cycle, but if you're trying to do C properties and reposition them and flip them in this part of the market cycle, it's not going to work. Worked 4 years ago, but in this part of the market cycle, it's not going to work. And if you tried seller financing 2 years ago, they would have laughed at you. But now
Yeah.
financing's pretty sexy right now. So understanding when to use what and what part of the market cycle and what strategies to use will help you immensely.
Yes, yes, I agree with that. Okay, you mentioned, and so I'm going to go back just a hair because
Yeah.
my listeners here, a lot of them are brand spanking new to this industry. And we've mentioned the market cycle a couple of times. Can
Sure.
you elaborate just a little bit about what we mean by the market cycle and or explain a little bit how the market cycle works
I
so that
would love
they
to.
understand? Yeah.
That's an excellent question. And sometimes you can even parallel this. I think it should be paralleled with the interest rates because interest rates have a
Yeah.
cycle as well. So you're thinking about 2021, 2022, interest rates are really low, money's really cheap. They need to raise interest rates to take control of inflation. Inflation is not an increase in prices. Inflation is increase in the supply of money, which ultimately increases prices, right? So the Fed's job is to try to keep that under control. They said it was transitory, but it wasn't transitory. We all knew that
Mm,
was crap. They
yeah.
took too long and they shocked the system. So as you raise interest rates, you're slowing the economy down. And then you tend to go into a recession when you hit a certain, and you can look at all the patterns. '01, 2007, and basically the last couple of years. When
Yeah.
interest rates hit a certain high, things stagnate. Their silver bullet is, hey, we've got inflation under control because the economy's slow. No one's spending money. Let's start dropping interest rates. And that's what they're doing right now. They're trying to spur the economy because we are in a recession. People aren't spending money. They're afraid. When you
Yeah.
take the market cycle in real estate, it's very interesting. You have a buyer's market cycle and
Hmm.
then a transition over to a seller's market cycle. Or you can talk about when you're going into a recession, which I would say phase one. The next
Yeah.
phase, recovery, phase two. Then you have expansion, phase three. Then you have hypersupply, which is phase four. Now, unfortunately, every market is local. Now, you can have a national market cycle. But
Okay.
what's going on in Huntsville, Alabama is a lot different than what's going on in Cleveland, Ohio. Huntsville may be in hypersupply right now because they produce so many assets and they're just churning it out and they're not getting absorbed right now. So they may be in hypersupply, getting Cleveland that's just sitting there between recession and recovery. So understanding where your market is and to correlate that into the strategies. When we started back in 2011, we were definitely in a recovery. The recession was
Yeah.
technically over, but we were recovering. Market was starting to go up. That's when you can buy assets that are older. That's when you can do the Burr method, buy them, refinance them, roll them out, get into the next one. That's when you buy older assets and pour a ton of money into them with CapEx and fixing them up. But at a
Yeah.
certain point, it's recovered and now the market's expanding, starting to grow. Now you're starting to flip these assets. All of a sudden, deals are on the market for 18 months and they're flipped and they're flipped and they're flipped. Then you get into hypersupply, which is a lot of these markets right now. You have Nashville, you have Atlanta, you have
Yeah.
Charlotte, Phoenix. They have such an oversupply and overabundance that they are precariously may go into recession. And ironically enough, rents are dropping because there's too much of a
Yeah.
supply. So understanding that is then you'll figure that piece out and go, okay, I'm an expansion. I need to be careful because the window of the market dropping is 2 to 3 years. The typical cycle from start to start is between 8 to 10 years. Now, the weird part was this last market cycle, there was no recession during the 2010 to 2020. I think the only time in history that we didn't have a recession in a decade.
Wow.
COVID pushed it out, obviously. That's what ended up
Yeah.
happening.
Yeah.
But understanding that, now you're saying to yourself, where are we right now? Right now, we are going back into a buyer's market. The sellers, we're at the top of 2022. Prices are down 20% from 2022, and they're still dropping. Sellers, and you can tell the sentiment from brokers, there's less deal flow. There's more what we
Yeah.
call retrading. People are asking for concessions. There's more
Yeah.
seller financing going on. It's harder to raise money. These are all pointing to the buyer's market, to favoring the buyers. Whereas
Yeah.
the sellers 2 years ago would throw something online and it'd be sold in 20 minutes. Whereas now you go on
For real.
LoopNet and yeah, really. And now you can go on LoopNet and there's actually deals on LoopNet right now. That's how things are changing. And the other thing I think is buyers are understanding that they're not going to overpay. With the rates where they are right now, they can't overpay because the cost of capital is too expensive. So understanding all that now, believe it or not, the counterintuitive part of life and of nature is when you should be getting into real estate, when everyone's the doom and gloom and everyone's running. This is the
Hmm.
time, just like when Jake and I started back in 2011. Let's put our little history caps on. That was not the right time to get into real estate. It was horrible. I
Yeah.
needed to get into real estate. I needed Jake. I needed to buy deals. The market didn't care. I was just lucky getting into it at the right time and putting all that effort in and letting the market do a lot of the work for me.
Yeah, that's great. Thank you so much for that. I really appreciate it. I'm sure that our listeners also appreciate that explanation because it's really hard to understand that in layman's terms. We can
Yes.
Google all we want, but putting in layman's terms like you just did and allowing us to understand the details of it, that makes a huge difference. Okay. So next couple of things are we're wrapping up here. So I have a couple of questions for you. The first one is who or what inspires you the most, whether it be on your real estate journey or in life in general?
I would say my wife, believe it or not. I'm glad she's not listening to this because we have 6 children. She homeschools the kids.
Oh my gosh.
She doesn't have a
Superwoman.
yeah, she doesn't have a day off, and I never really hear her complain, "I'm tired, I'm hungry, I don't feel like doing this." She just figures it out, and if you're surrounded by a person like that, you can't sit at home and go, "I don't feel like doing this," or "I've got problems."
Yeah.
You have to step up your game, and you can't
Yeah.
make excuses because your partner's not making excuses. So for me, the simple answer would be my wife.
I love that. I love that. And that also speaks about the kind of husband that you are to her as well. So kudos. Okay. So podcasts other than multifamily missteps, give me a recommendation of podcasts. And please, by all means.
It's interesting. I don't really listen to podcasts. I like to read a lot of books because I interview a lot of guests. So
Okay.
right now, Psycho-Cybernetics, believe it or not, it's a boring book, but it's amazing when you talk about personal development and psychology and brain. It's such a powerful thing to think of your past and your childhood and what happened in those traumas
Mhm.
that happened back then and the identity that you grasp. And it's affected me because it took me years to get out of that pizza guy mentality. I was the
Yeah.
pizza guy. How am I going to be a multifamily investor if I don't shed the identity of the pizza man? And I understood that I was holding myself back. And I'm like, how do I do this? So that book really helped me out. There's tons of books. Another book that I'm reading, Dale Carnegie. I think Dale Carnegie's books are so
I love it.
simple,
Yeah.
yet they just speak to me. Stop worrying. How to
Just
create friends. How simple, yet none of us do any of the stuff that he says we do. And if you could just put that on your list and you want to get brokers to call you and you want to get lenders to call you and you want investors to like you,
come
we'll
on.
get to know them and read Dale's stuff and you'll be able to have people knocking on your door like you wouldn't believe.
Absolutely. And let me tell you, this is a real relationship business. This is not just a one and done type business. If you want to get in this business, relationships are very important. So
Mhm.
yes, yes, Del Fargi is awesome, awesome. And since you're not going to plug it, I'm going to plug it. Guys, look him up on YouTube, Jake and Gino, the Jake and Gino show. You can see it on his background. They are awesome. They are hilarious. They add value every single time that they get together and a microphone's in front of them. So look them up online as well. So how can we get in touch with you, whether it's to sign up for your educational program or learn more about it? How can we get in touch with Gino or Jake or both? How do we do that?
There's 2 places. The first place, believe it or not, I'm gonna say Bigger Pockets before I pitch my stuff. I've been on Bigger Pockets the last couple of months. I've been answering questions, I've been posting stuff. If you're newer to the space and you just wanna learn now, listen, I don't advocate someone going on and saying, how do I set up an LLC? Or how do I get my accounting done? I see people doing that. It's just good to get general ideas. Use it as a mastermind. Ask people questions, formulate ideas, and then go out and get a professional to help you. I love Bigger Pockets. Great
Yes.
platform to use for that. And the second one is just go to jakeandgino.com. All our stuff is on there, our blogs, our podcasts, our books, our resources. Everything's on the website.
Awesome. Awesome. Gino, I am honored that you've added value to our listeners today. It's so great to have you here. Thank you so much for being here. We really appreciate it.
Thank you.
Absolutely. Okay. Till next time, family. Thank you for listening, and we'll see you again.
Thank you for listening to another episode of Multifamily Missteps. Your dedication to our podcast is truly appreciated. Please help us spread the word and make our community even stronger. The valuable lessons that our guests bring each episode will help you and others avoid these missteps along your journey. Hit the subscribe button, take a screenshot of the episode you just listened to, post it on your social media, and tag myself and my friend Jerome Myers. You never know, you might find yourself our next featured guest. I cannot wait to continue this journey with you. Until next week, stay tuned and stay inspired.